My name is Max, this is UNFTR, and this episode is short and sweet, but it is oh so important. See, now that economic data is flowing again after the government shutdown, we're getting some negative indicators all around the U.S. economy. But with everyone focused on the here and now, they're missing a much larger picture. Our economic position in the world, the very sovereignty and the might of the U.S. economy, is in a perilous state. Now, like Chicken Little, I've been warning of an implosion for several months now, but today I'm going to show you how and why it is already happening, leaving the only open question as to when it actually just collapses. These are the verifiable receipts printed by our own agencies who can whitewash the narrative all they want, but they can't hide from the reality. So here's what I'm going to show you and how we're going to go about it. This is a macro picture that puts the U.S. economy in global context. So we're going to explain the nature of our debt and deficits, talk about the cost of financing them, how Japan just gave us the middle finger and why that's a nightmare, and prove how the financing of our debt has turned into a Ponzi scheme because we are driving away buyers of our treasuries. But first, a spoonful of sugar to make the medicine go down by watching Scott Bessent get his just desserts just before dessert. And then I'll finish by answering the question that's on everyone's mind. And I know it's on everyone's mind because it's the question that I get the most. So let's go. UNFTR. Okay, so first, the spoonful of sugar. Recently, my favorite Trump official, Scott Bessent, the world's worst hedge fund manager, the guy that lost 90% of the value of his $5 billion hedge fund when he left the warm embrace of George Soros and struck out on his own over the same time period that the S&P 500 gained 167%, which made him the obvious candidate to put in charge of the finances of the largest economy in the history of the world. Well, Scott was trying to enjoy a lovely meal with some friends when this happened.
We have a special guest here, and we want to make a toast for the Secretary of Treasury, Scott Bessent. Oh, yeah. So let's give it up for the man who is eating in peace as people starve across the world based on his sanctions, which are economic warfare.
Of course you're going to boo this. It's the truth.
He oversees the death of 600,000 people due to sanctions annually. And this president, let's cheer to the Monroe Doctrine.
As if this wasn't delicious enough, here's my favorite part.
The blood is on your hands.
The blood is on your hands. You should be ashamed.
Did you see that? Fucking Karen actually asked to see the manager. I love this woman, by the way. I want her to get the Presidential Medal of Freedom if we ever get another president. Anyway, in addition to the very true accusation she hurled at him, it's also true that Bessent has lost control of managing this economy. Now, it's not entirely his fault. I mean, he's fighting the tide at this point because of the derelict nature of Trump's policies. I mean, the labor force is being gutted. Inflation remains sticky no matter what the recent inflation print says, which is the subject of another video, but most economists basically called bullshit on the recent drop. Tariffs destroying the trade economy because the world is reorienting the supply chain around us instead of it promoting domestic manufacturing. The reduction in entitlements and the gutting of federal agencies is already wreaking havoc on the poor and the working class, and we're only officially 1 month into Trump's first fiscal year, believe it or not. So this is going to go even more sideways when millions of people lose health care or see their premiums double in the new year. I could go on, but the point is to illustrate the fact that Bessent is chasing his tail, trying to tame the markets by browbeating the Fed into lowering interest rates and shifting our debt obligations from long-term to short-term. He's also been encouraging our allies, or what's left of them, to increase their purchase of U.S. treasuries to no avail. Now, I can understand him acting like the house isn't on fire because that is his job. What I can't abide by is that he's parking his car in front of the fire hydrant. So let's start off with the debt picture. Our debt story begins with the Great Depression and spikes during the Second World War. Through various mechanisms, the U.S. government kept a lid on the total level of debt, as you can see here, adjusted for inflation, until Reagan exploded the deficit with military spending and tax cuts in the 1980s. Since then, we have been on an unprecedented run, as evidenced by the spike seen here. So one very valid question is, how did we pull it off all those years while the debt was skyrocketing? And the answer is that the debt service as a percentage of GDP was manageable. We were in growth mode, fueled by deficit spending. And more importantly, as the world's reserve currency, there was always an appetite for US dollars. For most of the last 75 years, the currency of global business has been the dollar, the result of the Bretton Woods Accord that we've spoken about ad nauseum on this channel. We fund our deficits by selling interest-bearing treasuries to the global market, which loads us up with dollars, but also debt. So long as we were A, growing, B, stable, and C, the reserve currency of the world, no reason to panic. The problem today is A and B. The existential threat to our economy is C. Now, in terms of what we do with the dollars we bring in through taxes, tariffs, and issuing debt, which are the only ways that we make money, the most notable change over time is the percent of the federal budget that goes towards servicing the debt. Interest payments on our debt are now 15% of the budget, second only to Social Security and tied with Medicare. Now, moving forward, all things being equal, if Social Security and Medicare remain part of the budget, and in spite of GOP efforts to privatize these programs, the costs of these are going to increase as the baby boomer generation ages. And with Trump's tax cuts on top of prior administration tax cuts reducing revenue, we have to fill the gaps with the other two levers we have, tariffs and debt. And we all see how tariffs are working out, so it's pretty obvious that debt is going to be the driver. So let's talk about that 15% outlay, the interest on our debt, because this is the core of Bessent's job as Treasury Secretary. To manage this, he has been doubling down on a strategy that he previously criticized before he was in the seat. He's shifting away from long-term bond auctions to load up on short-term notes, to the point where we have more than $9 trillion in U.S. debt coming due in 2026 alone, which is staggering. Now again, in and of itself, it's not a terrible strategy, but both the strategy and the outcome currently tell us something really important. Here's a look at the 30-year Treasury. This is a 5-year view of the yield. This is the interest that the market determines we have to pay to find buyers. Put simply, it's high. It's close to 5%. And this is the 10-year. It's about 1% lower than the 30, but obviously comes due in a third of the time frame. And it too is high, and despite the administration's best efforts to sell the world on the idea that America's heading in the right direction, it remains elevated even after the Fed cut its core interest rate to try and juice the economy. An interest rate is basically just a risk premium. Just like your credit card company or your auto loan or mortgage holder puts you in a certain bucket based on your financial profile like credit score, outstanding debt, your payment history, etc., the market basically does the same for government debt. Like if you think that a government might default on its debt in 5 years, you're going to buy a 10-year note really cheap, and it's going to pay a ton. So the longer the term of a loan, the more that can go wrong. So that makes sense. If you think that a country might be worse off in 10 years or 30 years from now, you get a risk premium. That's why Bessent has been shifting to short-term durations. We have a ton of debt, so we might as well roll it over into the cheapest interest instrument possible. The problem with that, as you can see here, is that even our short-term debt is higher than we want it to be. This is the 2-year note, for example. But hey, it's a few basis points below the 10-year, and we're trying to squeeze out as much of these auctions as we possibly can. So that's the strategy. Fuel our deficits by issuing more debt, just of a shorter duration. Now let's talk about who's on the other side of the ledger. Who's actually buying our debt? First off, we buy some of it ourselves. The Federal Reserve can create money for the express purpose of buying our own debt, something that they do on a regular basis to ensure that we have dollars. It sounds counterintuitive that we would print money just to buy our own debt, but it's how we keep a certain amount of liquidity in circulation. Then we have our own financial institutions who purchase treasuries as well because they pay interest, so why not? The bigger market, though, is outside of the United States, so let's have a look at it. There are two things I want to point out here. The first is you'll note an asterisk in the title, and also that I've highlighted the Cayman Islands. We've done a separate video on this alone, so I'll give you a brief recap. This is data pulled directly from the U.S. Treasury, and they list the Caymans as an official source of purchases for our debt. Of course, their holdings are bigger than the GDP of the Caymans, so what it means is that there are companies that are domiciled there that are credited with the holdings. But the bigger story is that this number is actually fake. In October of 2025, the Federal Reserve released a bombshell paper that pulled SEC data and showed that sources in the Cayman Islands actually own about $1.8 trillion in U.S. debt. The figure reflected here is about $400 billion. So the Treasury is somehow undercounting the amount that hedge funds, likely from the U.S., but listed in the Caymans, by about $1.4 trillion. And no explanation yet for the discrepancy. So that's pretty fucked up, because where is that accounting? The second thing that pops out is that Japan is far and away the largest official owner of U.S. debt, at least according to the Treasury. And this is where things are starting to fall apart. Japan is having its own moment. After decades of running near zero and sometimes, believe it or not, even negative federal interest rates, the Bank of Japan, or the BOJ, has been increasing the rate over the last year. Now, the new government is trying to slow the pace of inflation in Japan by gradually hiking rates, which it is their prerogative to do. So it recently announced another rate hike on December 18th, which was expected. But then they also indicated that future cuts were almost a certainty. And this trend has caused the yield on the Japanese 10-year Treasury to increase dramatically. So as of this month, the Japanese yield is almost 2%. And the yen is also losing value because they're still engaging in their own form of quantitative easing. So translation for all of this, and here's why it matters. The primary reason that Japan has been such a huge buyer of U.S. debt is because the yen is low compared to the dollar, and their yields have been close to zero. So what Japanese investors and global investors alike will do is participate in something called the yen carry trade, essentially buying discounted yen, switching them into dollars, and then buying dollar-denominated assets like U.S. Treasuries and even stocks. It's a form of investment arbitrage that allows them to take a bit of upside on the disparity between the dollar and the yen and put them in places that have better returns. But now, the U.S. dollar is losing value. It's down about 9% just under Trump's second term. And it's also thanks to Trump's policies, but the yields on Japanese bonds are also increasing. So this arbitrage play isn't as attractive. And in fact, now it carries a lot of risk because these aren't overnight vehicles. So the longer the term of these investments, the greater the risk that your trade goes upside down. And so people pulling money out of this position is called the unwinding of the yen carry trade. This is where investors begin shedding U.S. positions and start loading up on Japanese assets. And for Japanese firms, it's just a matter of repatriating yen into the Japanese economy. And the person who's been on the road for months begging them to stop raising rates is Scott Bessent. So the fact that the number one official holder of U.S. debt allegedly just gave us the middle finger basically means they're like, you're unreliable, you're not the boss of me, and I got to take care of my own. So good luck. And we know this is happening because after months of wondering what was going on in these treasury auctions, meaning who was buying and who was selling, we finally have some information from the new Treasury International Capital, or TIC data releases, and it's stunning. First, here's the headline. These releases lag, so we're just now getting a look at October, and it showed that not only did foreign official sources, meaning other central banks, sell U.S. assets more than they bought them, but so did private sources, meaning corporations domiciled outside of the United States. That is a terrible month. That never happens. The only other time we saw it was actually this year in April because of Liberation Day, when the world markets freaked out on us. That's when Trump reversed course like a couple of days later on the big tariff regime, and that's when he earned the nickname Taco, Trump always chickens out. But everything reset in May, at least in the private data. And I have to be extremely clear on this. Government sources have been on the decline for years, but on balance, the United States always brings in more investment capital than it sends out. Now, remember that piece specifically as we look at the details, because that's what's not being reported out here. All right, so check this out. These are the official sources, basically other central banks. In October, we had a net outflow of $24.8 billion in U.S. Treasuries. So you can see at the bottom that the U.S. stock market, however, took in a net of $7 billion. So this means that $24 billion left our debt market, but that central banks are still investing in our stock market. Now hold that point on stocks for the end. But the bigger takeaway here is the trend. Look at the highlight at the top. In the 12 months ending October of last year, central banks still invested $31 billion more in U.S. Treasuries than the U.S. invested outside. Now, through October of this year, that number reversed. We saw a net outflow of $100 billion. Unfuckers, this is the definition of sell America. See, in prior crises, no matter how terrible things were, here or abroad, we were always the beneficiaries of central bank investments, of foreign central bank investments, because we were the sure thing. So this means that the governments of the world are even starting to work around our debt, just like they're reorienting the supply chain because we're such terrible economic partners. Understand that this is a combination of other central banks losing faith in our long-term ability to manage our debt because we keep doing things like cutting taxes and shutting off immigration, and them telling us to go fuck ourselves. Now, let's look at what the corporate world is doing on the other side. Again, private sources could be sovereign wealth funds, mutual funds, hedge funds, corporations, etc. Non-central banks from around the world. So on the top line, you see that through this year, we have taken in almost $350 billion more through October of this year than we did through October of last year. These are full year figures. But there was a net outflow of U.S. Treasuries of nearly $300 billion over the same period. So this means that the gains have almost exclusively been in the stock market. Stocks are overvalued by a lot. Any prior metric used to determine where equities were in the valuation cycle have gone completely out the window. The Buffett indicator, the Shiller PE ratio, price to book, it's all shit now because number go up, right? This is the world that we live in. Moderate corrections here and there, huge drops during catastrophes, but then everything pours back in because the U.S. stock market is the best investment on God's green earth, which means we have half of the answer to the question that I always get. Why hasn't the stock market crashed? Well, three-part answer. Weight them as you see fit. Foreign sources are selling American debt and reinvesting in our stock market because, number two, there's nowhere else to go, which means it has essentially become like gold, which brings us to number three. The stock market has become a store of value for baby boomers. As you can see, the S&P, for example, has tracked pretty close to the trajectory of gold prices. Beneath this statement, there's a whole other story that explains why the top 1% is pulling ahead and purchasing power for the rest of us has declined so precipitously over the decades. So here's how I can explain it. The value of gold, like the actual metal pulled from the ground and melted into a bar with a weight, the value of it hasn't changed, but the price has. Just like the value of your home, the lumber, the four walls, the roof, and everything that runs it, the value of these components, and as such, the whole of it, hasn't changed. If anything, if you haven't improved it and made upgrades continually, the value of it has arguably declined, but the price has gone up. The value of these companies in the same way, the money that they make, their impact on GDP, their benefit to humanity and the economy, may or may not have increased, but the price has absolutely. And that, my friends, is economics. Socioeconomics is the discipline of understanding how these economic factors impact society. Home prices increasing means they've become a store of value. In fact, the primary source of equity for folks who have at least paid down enough of their mortgages to even have equity. In other words, baby boomers. Gold increasing in price means that institutional bidders have begun to purchase it in large quantities as a hedge against inflation. And those institutions represent the investors who are in their portfolios, in other words, boomers, or companies and countries that are run by boomers, and company stock prices inflating beyond any measure or performance or economic contribution has also now become an inflation hedge, a store of value. See, money goes to money. That is a truism that has always been around. But big money also goes to money in bigger ways. Asset inflation is the direct result of money printing, which is the direct result of deficits. See, we've made a choice to allocate the balance of big money to assets like homes, to gold, and to stocks, and away from the public. In fact, we extract money from the public now really just to offset our debt payments and to pour into programs that benefit, say it with me, baby boomers. The entire economy is designed to aid and support the 60-plus population that already has accumulated assets, and to ensure that these assets act as a hedge against inflation. It's why your purchasing power since Ronald Reagan has decreased dramatically unless you were part of the cohort that already had access to accumulating these assets. So if you owned a home or you had a portfolio that could invest in things like gold or the stock market, you were in a good place. If you didn't have that type of discretionary funds, you were out of luck. And if you're entering the market now as a Gen X or a millennial or anybody underneath that has been working along and looking for that moment when you would begin to accumulate the net assets, the net value and the equities in these assets, you're kind of shit out of luck because the inflation of the assets has priced them in a place that we can't get there unless we go into a massive amount of debt. And the cycle continues. And if you look at the fiscal policies of the Trump administration, the picture comes into focus. Inflation will increase because they're cutting interest rates and they're cutting off growth by halting immigration. They're cutting taxes and have created new loopholes for corporations to put more money aside faster, like the ability to depreciate assets in 1 year instead of over time. And that's on top of cutting corporate tax rates. And they've reduced estate taxes while increasing the amount that you can pass along before these taxes even kick in, because they intend to keep the money flowing within the same small circles while they maneuver the economy to prop up asset prices. You know, as a hedge against inflation. You think AI is a bubble? How about America? If you dug this and you want more of it, make sure to subscribe to the channel and sign up for our free weekly newsletter at unftr.com. Thanks as always to our members for supporting our work, and I'll catch you online.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the world needs. Started a podcast. Another basic white guy who started a podcast. But it's fun because he curses.